Hi, guys. Welcome to the 29th episode of the weekly trading wrap up, WTW, where we talk about the week in markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. As usual, we start with the picture of the S&P 500, the market, as I like to call it. Okay. This arrow denotes the week of June 2nd. Okay, we have Monday here. You can see Monday, Tuesday, Wednesday, Thursday, Friday. Up week, stairway to heaven, if you will. It looks like it was consolidating and then it sort of broke out this week. Broke out of this small little pattern. We have a huge uptrend going ever since the lows of, let's say, April. So let's talk about the technical picture. As always, that's how we begin. So let's bring out the moving averages once again. As you can see, the most important one here is the 200-day moving average in blue. It broke above it a couple of weeks ago, 2-3 weeks ago, on a gap up. I thought that during this time, as it was consolidating, we'd cover this gap. We didn't. We started powering higher. So technically speaking, we have a bullish uptrend. It hasn't been broken. We are trading above all moving averages, especially the 200. And notice that the 200-day moving average after this big crash was flattening out, and now it's starting to go up again. So this is all very bullish. Okay, so technically speaking, we are in a bullish mode. Okay. We have the fear and greed index as we look at it normally to get sentiment. However, we're at greed. However, it doesn't seem to be working in my view because all of the sub indexes like market momentum, stock price strength, etc. Some of them are good. Some of them seem to be broken. And look, market momentum is fear. Okay, that means like we're down here now. It used to be extreme fear. Maybe they're in the process of fixing it, but this should be like extreme greed or greed. Okay, a lot of like. Here, junk bond demand is greedy. I don't know. Doesn't seem like safe haven demand is greedy. I don't know. Put call options are fear. No, they're trading at the put call options near lows. So that should be more like greed. So it's a little bit broken. So maybe it probably underestimates the sentiment. However, we also look at the AAII investor sentiment index. And here we have 41.4% bearish and about 32.7% bullish. These are the historical averages. We're still very bearish in sentiment. Okay, so fear and greed index, let's say it's starting to get greedy if you believe it. And the AAII is still with fear. So mixed messages there on the sentiment indicators, noting that the fear and greed index could be broken. Okay, so it could be even higher, which is even more mixed. Okay, so that's why we have the technical picture here is strong, and yet this and it's supportive because the sentiment data is not, it's mixed. There's fear and there's greed, but we would like to see if we wanted to increase our short exposure, is the sentiment become more greedy. Okay, we want this AAII to be much more greedy, much more bullish, and we want the fear and greed index. Well, although it's here, greedy. It would be better if it was at extreme greed. It might be at extreme greed right now. We don't know. So we have these mixed messages, which is good for the bullish picture. Okay. So the technical picture with the sentiment, bullish, as it's been since we're trading above the 200. Okay. What I think goes forward, like we mentioned last time, is the three possible scenarios that we have going for us. I think the most likely scenario, I said that the most likely scenario would be like a chopping back and forth during the summertime. The second most likely would be a bullish scenario. Consider this move a continuation and bring it to new highs. And the third and most unlikely scenario is the back down to lows. Okay, I still think we're in the camp where we go sideways. Okay, because there are a number of factors here which we will get into of why I think this move might be a little bit exhaustive. We'll see. Okay, So that is it for the technical picture. So let's move on to our macro. Okay, our macro. We had some good macro news come out this week. We had, first of all, the ISM manufacturing PMIs. We look at this all the time, and they came out at 48.5. Last time was 48.7, which is still in contraction mode. So for a long time, let's go back to that's a 1 year picture. Let's go to a 10-year picture. As you can see, for a long time, we've been under the 50 level, like since 2022. Okay, October, November 2022, we've been under the 50 level, which means that for 2+ years, we've been the manufacturing sector has contracted. Okay, so that's not good. So it's showing a slight contraction manufacturing. Okay. The other thing that came out. So wait. We have ISM manufacturing in contraction, and we have also the ISM services came out with a print of 49.9, around the 50. That's very low for services. If you can see, for the services usually stay above 50. This is the 50 line right here. It usually stays above 50. And for it to be downward sloping and going down is not pretty good. Okay, look, we had a downward sloping ISM services figure before the 2022 crash in the market. Okay, so this downward sloping thing doesn't bode well. However, we have market at highs and we have all the other macro data that we follow relatively solid. Okay, so let's keep an eye on the services, because if this continues to go low, that's very, very bad. Okay, so we have a little hint of something bad happening in the market, although everything else is bullish. Okay, initial claims came out. We always look at it every week. Now this is something to worry about. We saw 242,000 initial claims. So for 3 weeks in a row, 2 weeks in a row, it went from 226, 239, 247K. Okay, this upward is starting to go on our radar as a possibility that it could start breaking above these levels. Okay, if you go to a max, we don't have a max picture here, but if you go to a max picture, you'll see that anything above that is going to be very, very bad. So we have to see above, 250K, 300, 400, 500K starts accelerating. That's the problem. Okay, so that's why, if you'll notice that even when we take note of a potentially bad setup in some of our macro data, that it's going to take time before it happens. It's not going to happen in the next month or two. Okay, it's going to take time. You have to see a trend, and that's why I think that we're going to have a sideways scenario for the next couple months. And maybe, I don't know, September, October, we might see some significant downward move. But I still think we're going to get into a sideways market going forward. Okay? If not, we go with the bulls. Who cares? I have a neutral outlook. I have a neutral positioning right now. So we had initial claims. Keep an eye on it. We had ISM manufacturing below 50, and the services at 50, or what was the services? Services are 49.9, so right at 50. So those two are a warning sign. Initial claims, a warning sign. The next thing that came out is the non-farm payrolls, of course. That's what we looked at. That's what everybody was hoping for. And we came in at 139,000. And what were we expecting? We were expecting 130, so it beat. And yet the market on Friday, thanks to that beat, ripped and then stayed. Ripped. It went up from Thursday's downward day. It went up, okay? I'm not even going to mention the other macro stuff that came out, like with Donald Trump and Elon Musk going at it, and that could have spooked the market, whatever. That's not important, okay? That'll be a temporary move. So that was the macro that we actually look at. And also what is of note is that the GDPNow forecast came out, and they forecasted it, GDPNow here. I'm getting this from Zero Hedge, but you can get it from anywhere. It's from the Bureau of Economic Statistics, I think, the BEA or BLS, Bureau of Labor Statistics. I can't remember which government entity this is drawn from. Okay, it says here, sources are the blue chip economic indicators and blue chip financial forecasts, whatever that is. Now, the most important thing is that they estimate it to be at 4.8% for the coming quarter. 4.8%. Remember, the first quarter they said it was going to be minus 0.1%. My. It was just because of the front loading of the tariffs by industries. They still expect the economy to do okay. Everything is still okay. So we have our macro that is okay, and our technical, which is like bullish, which is bullish because it's not breaking down yet, and technicals are okay, bullish. So stay bullish, I guess. That's the main takeaway from all of the macro for this week. So let's talk about things that interested me this week. First thing I'd like to talk about is rates. Okay, the US 10-year benchmark. Okay, the US 10-year is still, it's a 4.5%. Okay, at the week, this is the week right here. Okay, so back and forth, and on Friday it ripped. Now, rates staying higher for longer is what I think will tank this market, destroy this market, although not right away. And the reason for that is that rates are staying higher because of the reasons that we mentioned last time, many times before. Record deficit coming, $2 trillion deficit, which means that rates are going to be higher. Financings, they have to refinance $7 trillion of debt, so huge supply coming, rates are going to stay higher. Unless, of course, there's even bigger demand, but that's beside the case. The market right now still keeps rates higher, and the economic outlook is still pretty good, so rates are high. Okay, and the Fed is not going to cut, nor did it show any inkling of cutting. Okay, we've seen that the Fed Watch tool what's it showing? We're at 4.25, so nothing. So let's say all of 2025. 2 cuts. 1, 2, very close. 1 or 2 cuts. I don't know where they're going to get the 2 cuts. I mean, the market came out with okay jobs reports, and it rips with rates staying high. Okay, I don't know. That doesn't seem very kosher with me, although it can. That means the economy is doing extremely well, and we're going to get inflation, although we saw how inflation is going down. So this, to me, is a worry. I don't know why the market really ripped today on Friday with TLT. Like TLT is like the long bond. It's the mirror image of this, and you can see it's at lows. And on Friday, it gapped down. So rates are going to stay higher for longer, and that's going to be the bane of the existence of this market, but not right away. Okay. So another thing that we looked at has to do with rates is the high yield bond index, and you can see the high yield bonds are staying relatively high. They're not signaling anything of, alarm. So it's doing exactly what the market is doing. It's coming back and going at highs. Although it didn't drift higher like the market has for the past week, it sort of diverged a bit from the market. Like the market would be up here, and these high yield bonds started going down. So is that a sign to come? I don't know. It's too small of a signal. It's noise. It's too small to make an inference out of. So that's what I just wanted to make sure that we kept a look on rates. And the one thing that it worries me is the US 10-year. Tariffs do not worry me. Tariffs will not kill this market. Okay, it's going to be the higher rates for longer, and basically the Fed staying behind the curve, keeping rates higher for longer, because the Fed is the most restrictive central bank out there. Every other central bank has lowered. I mean, the UK has lowered, 5, 6, 7, 8, 9, 10 times. The EU is down to 2%. Our rates are like 4.25%, and the EU's rates are 2%. 2 percentage point differential. Okay, so the Fed is the most restrictive central bank, and I think that's going to be the undoing of this market eventually, is that the Fed stays too restrictive for too long. Okay, it's the opposite of what they did with the zero interest rate policy and stoking inflation. Keeping rates too low for too long created the inflation, so maybe keeping rates for too high for too long create another crash. Okay, that's my biggest fear. That's my only fear going into this, is rates higher for longer. Okay, Another thing that I noticed this week is I don't even want to mention it, but CoreWeave. Okay. CoreWeave. This week, ripping. AI. AI is back. Chips, NVIDIA, CoreWeave is to me, this is probably a scam. Okay, so you have Euphoria coming back into the market, chips coming back into the market, even though, I don't know, the SMH is coming back to the semiconductor index is coming back to close to highs at these levels. Okay, but CoreWeave in particular is like, it's a deal with NVIDIA, where NVIDIA, these guys are buying NVIDIA chips from money being funneled to this company from NVIDIA. So it's like NVIDIA is like juicing up its sales, if you will. And if you look carefully, if you look into this CoreWeave board of directors, you will see these guys' names here come up. Jack Cogan and Michael Intrader. Okay, these guys, if you just look at them, they've been known to be part of some quote-unquote nefarious activity in the past, okay, especially through their, if you read carefully, through their net source asset management as it relates to carbon credit trading back in the day. Okay, a very manipulated market, and these guys had a big part in that. Jack Hogan and Michael Intrader. I mean, I personally don't trust these guys. They've been known to be around a lot of scams. So I'm just saying, when you're trading CoreWeave, be careful, okay? This looks like a retail trap to me. Take your profits if you're long. I don't trust this, okay? So this is like kind of like euphoric behavior as market is going to highs, okay? And you have this week also related to this, but not really, is Circle Internet Group, which is the makers of the stable coin USDC, which is huge. Okay, it's a big part of the crypto market, is that stable coin. Okay, this thing was supposed to IPO at $31, and it oversubscribed 25x, and now it's like it opened at $69, and now it closed 2 days later at 107. Okay, it's like up 30% just today, and climbing. If you can see, this is the aftermarket. It's even climbing in the aftermarket, up another $5 from the close. So I mean, this is like euphoric behavior towards the end of probably an up leg, in my view. So be careful. The Circle Internet Group. Okay, I don't know much about these guys, but just watch out for that. You have Circle, you have CoreWeave, you have all these things pumping it towards the end of the cycle, I guess. However, doesn't mean that if you have a couple of scams that the market's not going to go up. These guys could be destroyed, and yet the market can still go up. I'm just saying, be careful out there, especially for CoreWeave. And Circle, I wouldn't buy it. You don't buy Circle. You don't buy these IPOs right off the bat. Okay, you have to wait until they do something before entering, technically speaking. But you also have to have a fundamental view on it. And I don't really know much about the fundamentals of Circle yet. Okay, so that's it for those two things, Circle and CoreWeave. Another thing that I kept mentioning for a couple of weeks now is silver. I like silver. Mentioned it around here. This is the arrow denotes Monday. Huge up day on Monday, hitting that $35 level that's been resistance for a long time. I drew it here. I drew the major resistance levels with sideways blue markers. Okay, so as you can see, I was touting it for a while here. It was going to coil, looking very, very solid. In fact, a lot of the junior silver stocks that I have were outperforming, were up a lot even before silver went up. So it was as an indicator that something was going on, a small indicator, but I still liked silver coiling when it should have been tanking when the market was going sideways or down, because as the market goes up, you would expect gold and silver and all the metal stuff to go down, because things are like risk on, and like gold and stuff is supposed to be risk off, and silver is like a quasi gold, poor man's gold. So you would think that would go off too, but no. Silver held its ground and has been ripping for the past week. Okay, up a lot. Now, it broke out of the $35 level. However, We've seen this before. We've seen pumps and dumps in the silver price, in the silver market, very, very frequently. What you want to see as a trader is silver hold above these levels, maybe go a bit higher, maybe go 30, like Monday might be 37, 38, and then back down to retest the breakout point for a new massive move higher. Okay, that would be the textbook play of a classic breakout. Okay, and if it just keeps running, that means these guys that have been short selling at 35 for a long time trying to keep this metal down are going to get their shirts handed to them. Okay, but first, don't get too excited yet. This is just the beginning. We don't know if it's going to get faded quickly by the big boys, or if this is a real move higher. Okay, I want it to stay up here for a week or two, which is enough time to play out that scenario of it going higher, retesting doesn't have to go back down to 35. It can go back, maybe goes to 39, 38, and then stays around here, okay, which will be even stronger. But that's what I expect to see if this breakout is real, which I think it is. Okay. And another thing that came out on Tuesday is that Meta signed a 20-year nuclear supply deal with Constellation Energy. Okay, so we haven't talked about this in a while. Let's talk about the nuclear sector. Okay, Constellation Energy doing very well after the lows. It ripped higher. This was on Tuesday when they announced the deal, but then it got faded very quickly. Okay, it went up to 340 and then down to like 298 as of the close on Friday. Okay, so a lot of these nuclear utility stocks, not the nuclear miners, not the mine. This is the other end. These are the users, the suppliers of power. Okay, the users of uranium. Wow, that's a tongue twister. So this is the users of uranium, like also GEV, Genova. This was a good one too, new highs and staying there, very, very strong stock. So you have all these stocks, and of course, the only supplier of uranium, not user, but supplier, is Cameco, and that's back at highs, okay, recent highs. But if you look carefully under the hood, you see a lot of non-participation in this move, okay, in the uranium space. Like a lot of the other stocks, like Denison Mines, DNN, still in a downtrend. It spiked recently, but nowhere near the 240 highs. Okay, double top down. So this is bad. Another American uranium miner, Energy Fuels, downtrend. This move pumped it up, but it's a lower high. Okay. So you have a lot of these miners that are not producing. And if you see carefully here, where is it? If you go to the uranium price here, it's because the uranium price is down to $70 a pound. Okay, it was as high as above 100. I remember it in the beginning of 2024, February 2024. But I see downtrend and not going higher. Okay, this is why the stocks, the miners, are not really going up, but the utilities, getting the supply deals for AI, artificial intelligence. You have the suppliers going, the suppliers of energy, which is the utilities, doing very well. Okay, just not the miners because the price is still low. So it's a bifurcated market. You have to pick. In fact, for me, I'm looking to short these miners, especially UUU. I came very close to my price here, but then away from it. I might have to chase it down to get my short in. But I don't think this uranium move is going to be long lasting, especially going into the summer. This is not a seasonally good period for the miners of uranium. The utilities could be a different story. I don't know, but I suspect if the market continues to go up and the AI stocks continue to go up, so will their counterparts, the B team, which would be CEG. Stick to that. And GEV. Okay, even Oklo, which is like the Sam Harris one, will probably go high because that's the meme guys play this stock. Okay, so only a few names I would get into it if you want, not right now, but I am really looking to short, especially Energy Fuels going forward. Not for a big move, maybe back down to 350, but whatever. that is my look on the uranium space, because, like we said, U.UN is the Sprott Physical Uranium Trust. It's the price of uranium. It's still on a downtrend. It hasn't moved up. Okay, and without this catalyst going up, I don't see the uranium miners going up as well. Look, different story if it does, but as of right now, no. And I don't see it going up in the next 2-3 months. So that is my my view on uranium. So let's recap. Technicals, very bullish. Okay, although it might start getting exhausted, I still have some short positions that I took here in case this market corrects, which I think it might, because I mean the VIX is pretty low too. Not that it can't go lower; it's been lower for a long time, but the VIX is at 16. It could go to 15 and stay there. But I suspect that a lot of fuel has been used in this move, and if it goes back down, if it goes, you're going to see a lot of resistance at the highs, and it's starting to roll over. With the technicals not really rolling over, but you don't really need them to go to the SPY. You don't really need the RSI here, relative strengthening, to go to the extreme conditions. I mean, here, look, it was like pretty much flat before the big drop at highs. So it's just a question of people being too long options, jumping aboard these meme stocks, going into CoreWeave, Circle. All this hype is happening and everybody's jumping in at the end. I think we see some kind of correction. But because like the AAII sentiment indicator isn't fully bullish yet, I think any drop was going to get bought up and we stay pretty much around these levels. So that is my outlook for the future, and looking forward to next week. Take care, guys.